S&P 500 Futures by www.profitabletradingtips.com. A common means of trading based on economic indicators is to trade S&P 500 futures. The S&P 500, Standard & Poor's 500, is a stock market index. The S&P 500 index tracks the performance of 500 leading and publicly traded U.S. companies. This index is often considered to be an indicator of the United States economy. The S&P 500 is maintained and updated by Standard & Poor's, who also do ratings of public and private debt. They are a subsidiary of the publisher McGraw-Hill. The ticker symbols for the S&P 500 are GSPC, INX, and $SPX, depending on the market you are trading in. As with many traded equities, the index also is traded as S&P 500 futures. The futures trading strategy that one follows in trading S&P 500 futures may be different than what one uses to trade individual stocks. An index that tracks the U.S. economy. The S&P 500 index is a composite of 500 stocks. Starting alphabetically with 3M and Abbott Laboratories, it includes Apple and Microsoft, Avon and P&G, Ford, General Electric, and General Mills. Not only is the index a measure of the strength of the U.S. economy, but it is also a measure of the length and breadth of the U.S. economy. As such, a major gain by Apple, 3M, or P&G will only move the S&P 500 and S&P 500 futures prices a small amount. When there is a market crash, the entire S&P 500 falls along with futures contracts on the index. During the same time, an individual bank or consumer services stock may rise in price. Trading the S&P 500 and S&P 500 futures is trading on the ups and downs of the U.S. economy. Futures and options on futures. As with all futures contracts, it is often possible to trade options on those contracts. In trading futures options on the S&P 500, the same fundamental and technical analysis applies as with trading the index or its futures directly. The benefit of buying options on S&P 500 futures is that one limits risk to the cost of an options contract. Calls on S&P 500 futures give the trader the right to purchase a future at a set price, no matter how high that contract price might go. Puts allow the trader to sell a futures contract at a set price, no matter how low the price might fall. In each case, call or put, a futures trader is not obligated to purchase or sell and will only do so if it leads to a profit. As options contracts have value up to the moment of expiration, traders often buy a call or put and then sell in order to limit loss or to ensure a profit. In and out with a profit. Many futures traders never intend to buy or sell the equity on which they are trading futures. This applies to S&P 500 futures as well. The most common approach is to exit the contract by executing the opposite trade prior to expiration. In fact, in profitable futures day trading, one enters and exits contracts throughout the day, taking small profits as able. For more insights and useful information about currency trading, visit www.theforexnittygritty.com.